Welcome to The Death of the IPO, How Private Markets Won. We're diving deep into one of the most profound shifts in modern capital markets. For decades, the initial public offering, or IPO, was the definitive gateway to public markets. But today, it's becoming a burdensome legacy system. The traditional IPO is a 20th century capital-raising mechanism. It was designed for a world where institutional gatekeepers controlled access and information. There is a massive and growing mismatch between how modern private capital markets operate and the outdated, rigid processes of public listings. So where exactly did the traditional IPO fail the modern company and the modern investor? The process is notoriously slow, opaque, and heavily controlled by investment banks, who act as the primary gatekeepers. Retail investors consistently gain access to these companies only after the majority of value creation has already been captured in the private phase. The first major financial hurdle is the 7% toll, detailing the massive underwriting fees that transfer immense wealth from the founders and companies to investment banks. Banks extract billions annually from issuers, and these high fees are levied regardless of the company's long-term performance post-IPO. These high fees fundamentally distort incentives, pushing banks to focus on deal volume rather than ensuring fair and accurate pricing for the issuer. Next, let's address the persistent myth of the IPO pop, which is, in reality, a massive mispricing error. The first-day surge in price, or IPO pop, costs the company billions in, quote, money left on the table. This value is immediately transferred. This structural underpricing functions as a hidden wealth transfer, primarily benefiting institutional hedge funds and favored clients who get shares at the lower initial price. This brings us to the alternative. The mechanics of direct listings, or DLs, the new path to public markets. A direct listing is fundamentally different because it is not primarily a capital raise. It is purely a liquidity and price discovery event. In a DL, the exchange itself becomes the primary marketplace, bypassing the bank-controlled allocation process completely. The company lists existing shares directly to the public without a primary offering. This means no new shares are issued immediately. This structure is crucial because it allows founders, employees, and early investors to monetize their shares directly and immediately. Direct listings are particularly attractive to mature, often profitable, or well-capitalized tech firms that simply don't need a cash injection. For these cash-rich giants, avoiding dilution of existing ownership is the primary motivator for choosing a direct listing. Companies like Spotify, Coinbase, and Palantir have famously led this charge, prioritizing liquidity and price efficiency over massive underwriting fees. By avoiding the primary offering, they protect their cap table and their long-term governance structure from being immediately diluted. Now let's examine the broader trend, the fundamental shift toward private market dominance. Late-stage private rounds are now effectively replacing the traditional IPO as the critical funding mechanism for growth. Companies now arrive at public markets fully scaled, often profitable, and valued in the tens of billions, having already completed their hypergrowth phase privately. The SEC has recognized this trend and is streamlining direct listing processes specifically for high-valuation decacorns to ease their path to public trading. This regulatory evolution reflects the acceptance of alternative listing models, with many direct listings now permitting a capital raise alongside initial liquidity. The stay private longer phenomenon is undeniable, characterized by companies achieving enormous valuations while intentionally avoiding the public markets. The unicorn life cycle now stretches well over a decade before a public debut, meaning private equity and crossover funds are capturing most of the value creation. Let's explore the consequences of this shift in terms of liquidity and wealth concentration. Liquidity is increasingly occurring in the private markets via secondary transactions. Public investors are now buying mature companies, not early-stage growth stories. Direct listings effectively solve the restrictive lockup problem for insiders, allowing employees and early investors immediate, rather than delayed, liquidity. The math of inequality is clear. The majority of a company's financial value creation now happens during the private phase, limiting access for public retail investors. The shift away from IPOs also brings a profound improvement in market efficiency and pricing mechanics. Digital transparency and social media allow founders and CEOs to talk directly to the market, effectively ending the outdated roadshow circus. Direct listings rely on real-time price discovery via a market-driven auction, rather than relying on a banker's gut feeling or allocation strategy. What does this mean for capital strategy and the future of public markets? Massive sovereign wealth funds and private equity firms are providing permanent capital, replacing public markets as the primary source of scale-up funding. We are predicting a private-first world, where a public listing becomes a branding choice and a final liquidity event, not a financial necessity for growth.